Earnings recovery, coupled with strong economic fundamentals and positive investor sentiment, have boosted many global markets to double-digit gains. Japan's Nikkei has been the outperformer, while US shares also hit highs thanks to mega-cap and AI stocks. Safe haven assets like gold and the US dollar have also sheltered investors amid geopolitical uncertainties. As the US Federal Reserve hints of one potential rate cut within the year, equity markets could remain upbeat. Experts say a 25 basis point cut could happen this quarter once inflation shows signs of slowing down.
It's possible that the Fed could actually cut rates twice this year, once in September and once in December. And we say that because there are signs that the US economy is running into a soft patch. It is slowing down. We are fairly confident that inflation will head further south. The labour market is showing signs of weakness. Consumer sentiment, some of the recent readings have also shown signs of weakness. And all that could translate to further falls in inflation rate and trigger a Fed rate cut in September.
Inflation and the Fed's dot plot will likely continue to drive markets. And with $6 trillion of liquidity sitting on the sidelines, some say US equities could be set for a multi-year upturn.
If the Fed starts cutting rates, then there are less reasons for those investing in money market funds to stay invested in money market funds. They'll start looking out for other investment opportunities in equities, corporate bonds, and that could, help to fuel a rally.
But until then, how should investors position their portfolios?
So for Q3, I think investors need to be careful because it's been an uptrend so far. It's easy to get a bit complacent. So what they need to look out for is a possible pullback or retracement, which is necessary for a healthy market structure. What could drive that? I would say that would be still inflation, which has been a key driver all this year and last year. And the other thing would be political changes.
If you need the money in the next 6 months, then you should right now reduce risk. Because the market has rallied, it's a good time to reduce risk. Second question would be, do I want to outperform the market or do I want to, I'm happy with what I get in the benchmark? If you want to outperform, then you have to do some tactical rebalancing.
Investors preferring to track momentum can look at shoring up their holdings of AI stocks and big tech semiconductors, while contrarian investors can opt for fixed income and real estate investment trusts or REITs, which have been beaten down by high interest rates.
If you take a 3-year view, then yes, fixed income is also something which can give you good returns, and same as for REITs, where it can be a good asset class, where with the interest rate cycle reversing, you could see much more than just a 5% dividend play, but actually see some capital appreciation because the valuations have come down.
Still, 3 risks are top of mind. Inflation refusing to come down, higher interest rates for longer, and a potential decline in consumer spending. Economic and geopolitical uncertainty are likely to cause continued volatility, so investors are advised to stay diversified.
We are overweight equities, and the equity space, we are positive on Japan because of corporate governance reforms. We think China is a market that investors want to keep an eye on because of greater conviction from the Chinese government in terms of helping the economy to get back on its feet. US and Europe as well, although we are neutral, we think you should not ignore those regions because these are major markets in the world. And in terms of sector, technology is something to bear in mind because AI is really at the cusp right now, and there's a lot more potential over the next 10 years.
Energy stocks, related stocks would also be a good one, mostly alternative energy. So like, for example, solar, things like that on the other tangent, because the world is looking towards climate change and there's been a lot of interest for the long-term outlook in those areas. And Bitcoin as well, but not Bitcoin itself in general. It could be like mining companies or like a little bit more upstream related to Bitcoin.
You can keep some cash aside and say, I'm going to buy on dips, and over the next 6 months, every time there's a correction in the market, 5%, 10%, You go in and say, hey, I'm building a position. I would not get very aggressive with the tactical play of saying I will sell everything and sit on the sidelines. We've seen on many occasions such a approach becomes very risky because markets can continue to grow.
As all eyes focus on how markets will trend in the next few months, some say it pays to go against consensus.
What you want to do is to be able to recognize a good trend company or business before the market is able to recognize it. Mid last year around this time, we invested into an online Chinese recruitment company, and back then the stock price wasn't doing too well because people had a very negative sentiment, a lot of bearishness towards the outlook of the Chinese economy. But what the markets missed was that because people were very anxious about their jobs, they were willing to go onto job platforms, and that really helped them to drive their path to profitability.
Gen Z retail investor Calvin Che runs a blog with a colleague where they monitor financial markets and share investment ideas with a young audience.
We might be at a tipping point, so I'm a bit more skeptical this year. I still do my dollar cost averaging. I still put a large portion of my money into a passive pot. So essentially following the conventional market wisdom of putting it into S&P 500 and VWRA, which is the All World Index. Where I try to be a skeptical investor is really the active pot, where I try to see where I have a different view from the consensus, from the markets, and try to employ that. And so far it's been doing quite well.
Despite geopolitical tailwinds, US markets have continued to trend upwards.
The only big risk which is lurking around us is consumer spending. If spending goes, then businesses will get hurt. You can't do anything much with AI if people don't spend.
2024 is a year of opportunities, but it's a very reactive market. So it is a trade what you see type of market. So it would be good for investors to have like about a 3-month outlook each time. In terms of strategy, they need to have like a good asset allocation in terms of percentage. So while you do want to be taking opportunities on riskier assets, it's always a good idea to have something in, let's say, a safer haven like gold, just in case something happens, so that they can pivot anytime.
Investors should be capitalizing on opportunities to yield better returns over 2025 and 2026 once rate cuts kick in, spreading your investments out instead of trying to time the markets, keeping a diversified portfolio instead of trying to be overly concentrated in sectors or geographies. Investors ought to stay invested because while 2024 is going to be a tricky year and a volatile year, what the first half has taught us is that volatility and positive returns can coexist.